Welcome, everyone. Today we're going to be talking about the One Big Beautiful Bill Act. My name is Alec Sunners, and I've got my colleague with me, Drew Tignanelli.
Hey, Alec, looking forward to it.
So let's just jump right into it. And one of the big things that this act changes, or not really changes, but more so keeps the same, is the current tax rates. So the current tax rates were set to expire in 2026, but this bill is going to extend the current rates that have seen since 2017. So we'll see here up on the screen the current rates on the left. These are the different brackets you're in. So we've got the 10, the 12, 22, 24, 32, 35, and 37. Originally, before this bill, these tax rates were set to revert to old rates at 10, 15, 25, 28, 33, 35, and then 39.6. Another big shift with this bill is the increased SALT cap. So what is SALT and what is the cap? So SALT is your state and local taxes. Previously, this cap was $10,000. So when you go to either say, okay, am I going to take the standard deduction or am I going to itemize my deductions? All of your state and local taxes that you were paying, the cap on the amount you could deduct for your itemized deductions was $10,000. Now, the new cap is going to increase to $40,000, and there are phase outs for if you're higher income, so that's 250,000 for single and 500,000 if you are married filing joint. This SALT cap is set to expire in 2030. So we'll see if any new laws come up before 2030 to extend this again, or if that's going to revert back down to 10,000. True.
Yep.
This has been a big shift, and I think there's going to be a lot of different planning opportunities for clients that previously had not been able to itemize before.
Yeah, clients who are in high tax states like Maryland that we live in, you're going to have to get back into the swing of making estimated tax payments in December instead of January. This may help a lot of people to itemize that never were able to itemize before when the limit was just 10,000. I think this is going to open the door for a lot more people to be able to itemize. But you're going to find that this new tax bill has some surprises for itemized deductions and so forth. They call the administration calls this out like one big beautiful bill. But I just call it a pile on of garbage upon garbage because, tax laws have gotten so dang complicated. And this just, I mean, when you hear what we're gonna remember, what phase out is on this one? What phase out is on this one? Where do you get this deduction? When do you get that deduction? Some things sound same, but they're not the same. You're gonna see when we go through this, it's just more garbage upon garbage, but we have to remember it, and it's extremely beneficial to our clients.
Yeah, and if you're saying to yourself right now, oh, well, I'm under those phase outs, I'm going to get a lot of these deductions. Well, every topic we're going to talk about, it seems like they all have a different phase out for every single one.
Yeah, no doubt. Anyway, let's go on.
Yeah, so another big thing that was talked about in the campaign trail is tax-free tips and overtime. And this bill sort of addresses that. And for tips, up to 25,000 per person will be tax-free. If you are married filing joint, both spouses need to have tips up to 25,000 and you can receive 50,000 tax-free. But if only one spouse is receiving tips and they receive 50,000 in tips, well, only 25,000 of those will be tax-free. On the other hand, overtime pay, that is if the first 12,500 is going to be tax-free if you're single and 25,000 if you're married. And for that one, only one spouse needs overtime pay to get that full 25,000. So on one hand, you have the tips where you need both spouses to be receiving tips, but overtime, only one spouse needs to receive tips or overtime pay.
And this is a totally different phase out range. I think it's 150 to 300, right?
Correct.
So this one's 150 to 300. Now let's qualify the concept, Alec, of tax-free tips. Okay. First off, that 25,000 is tax-free for federal tax purposes. And it's only the tips that people were actually reporting anyway, right?
Yeah.
So it was only the tips that were coming through credit card charges or things like that that were then going to the employee and the employer reported as their tip. So that's going to come tax free. There's plenty of people who are getting tips that are going to continue to evade taxes because the 25,000 doesn't include Social Security and Medicare. So if you report any of your tips that the employer doesn't report over and above, you still owe Social Security and Medicare on that. And all your tips are going to be taxable in most states, if not all states in the country. So, yeah, you can call it tax-free on tax-free tips. But these two provisions really drive me crazy because this is bifurcating the tax system, right? Why this person gets tips and he's supposedly tax-free for federal tax purposes, but Alec gets a salary and he's got to pay taxes on that $25,000. And because you're a professional, Alec, I don't believe anywhere in your paycheck you ever get quote unquote overtime
Mhm.
because of the way your compensation overtime is only for certain types of employees. And and there's rules as to how that applies, and those are the only ones that are going to get overtime because of your salary and who you are and the profession you're in. You don't get any of that. No matter how much you work, you know.
You
Um,
could be a salaried worker working 80 hours a week and not receive any overtime pay, therefore not receiving any of that tax free.
Absolutely, absolutely. Because there's a word for it. I have to ask Mike. There's a word for it for employees. Exempt and non-exempt. I think those are the two terms. Exempt employees, they don't get overtime. Non-exempt employees have to have overtime, et cetera, et cetera. So anyway, it's just more complication and total bifurcation of the system. There's going to be a lot of people that are going to be looking for tips nowadays, Alec.
Yeah. Another quirky thing with the new law is there's this new auto loan interest deduction, and it's only for cars assembled in America. If the car is assembled outside of the United States, it's not going to be included for this deduction. There is a $10,000 deduction limit, and the car must be purchased between 2025 and 2028. And again, a different phase out for this. This is 100,000 for single and 200,000 if you're married, filing joint.
Yeah, and think about it, Alec. Even if you bought a car for $100,000 and borrowed all the money, chances are your interest for the first year is going to be about five, six, $7,000. So
Yep,
it's a heck of a car you're buying if you get up to the $10,000 deduction limit. And not many people are going to be getting this deduction because you got to itemize again, right?
yep.
And no assurance that a lot of Americans who are buying cars or with that kind of income are going to get much of an interest deduction. So anyway,
Yep, just another quirky thing that was included. Another big item in this bill was the larger senior standard deduction. So if you're over the age of 65, you'll get an extra 6,000 if you're single, an extra 12,000 if you're married filing joint. This is set to expire again in 2028, and this has another different phase out, 75,000 for single and 150,000 for married filing joint. And I'm going to say this with air quotes that this is supposedly the tax-free Social Security. And Drew, I know you have some thoughts on how they're calling that tax-free Social Security.
yeah, let's first point out that when we're talking about the phase out, whether it's the 75, 150 here or the 100, 200 we saw a second ago, or the 150, 300 or the 250, 500, that's the beginning of the phase out. So this is the beginning, 75,000 of the phase out. 150 for married filing joint. And these are over $100,000. So if you're single and you make $175,000, you don't get any of that $6,000 deduction. If you make halfway between 75 and 150, 175, which is $125,000, you get half of that single deduction. Same with married, it's $100,000 phase out. So, that's how that phase out works. But the administration made a big point out of we're going to make Social Security tax free. Well, they didn't make Social Security tax free. It's not even close to making Social Security tax free because if you look at your tax return next year, you're going to see your Social Security income coming on to the line saying this is your taxable income, which includes a hunk of your Social Security income. And the reason they claim that this is tax-free Social Security is because if you take the new standard deduction of 31,000, I think it's 31,250 plus the 12, and actually it's even more than that. It's 33,750 plus the 12 brings you up to $45,750. Something in that ballpark. And their argument is that because the first 45,000 of your income is not taxable, then your Social Security that was included in your taxable income is tax-free. And 90 some percent of Americans aren't going to have more than $45,000 of Social Security included in their income. But that's a total fabrication of tax-free Social Security because the tax laws are, they don't care where your income comes from, Somebody who's just working has no Social Security is going to get the first $45,000 if they're over 65, because there's plenty of people between 65 and 70 that don't collect Social Security, Alec, and they're going to get the same $45,000 deduction that the guy got who had Social Security. So anyway, it's the kind of stuff. It's like when the Biden administration said the Inflation Reduction Act. It's like, really? Where did you decrease inflation? And this administration, the Trump administration saying we gave you tax-free Social Security. Come on, let's be real. It just gets frustrating, doesn't it?
Yeah, it definitely does, because
It
a lot of
does.
people get confused about all of this stuff because they hear one thing, but they're seeing a different thing on their actual tax return.
Oh, I mean, they actually sent out an email, Alex, saying that an official email saying that we eliminated tax on your Social Security. Really? Anyway, let's go on.
So moving on to the next topic is estate tax. And originally the estate tax exemption was going to revert back to roughly 7 million in 2026. That number was supposed to be inflated out, so it was roughly 7 million. But this new bill is going to extend current law where they have a larger estate tax exemption, so it's going to rise to about 15 million now instead.
Yeah, this is important. I hate the estate tax. I don't think it's right in any way, shape, or form personally. I think that if people pay taxes all their life and they're able to accumulate a good bit of money, that's just the way life is, nothing wrong with that. I don't see where government should come in and take people's money away from them. If you're going to have an estate tax, maybe at $1 billion, okay? That's the way it originally was, Alec, that when the
Yeah.
estate tax was first passed, there were only 50 families in all of America that would have been applicable to the estate tax. It would have been Morgan and Rockefeller, et cetera, et cetera. And it got over time that, got down to all the way down to like a few 100,000 that, you know, people who had nominal net worth were being hit with the estate tax. Now they've raised it up to 15 million. you're at least getting into a range where it limits the amount of people that will ever have to deal with this, but still a good many families, well above 50 in America when it was first passed. But here's the point that we should think about when you live in Maryland, like we do, or any of the states that have an estate tax. That's mainly the Northeast states, Connecticut, Rhode Island, Maine, New York, Maryland. Believe it or not, New Jersey does not have an estate tax. That was interest. That's interesting. Minnesota, Illinois, the state of Washington, state of Oregon. In those states, they have an estate exemption that's a lot lower than 15 million. So you have this discombobulation between when you're going to pay estate tax to your state and when you're going to pay estate tax to the federal government. And you really need to make sure that if your net worth is over, let's call it $5 million, and you live in a state with an estate tax, you really need to make sure that your estate planning coordinates that difference when one spouse dies, when the first spouse dies. And that's very important. I can't get into the full, we ought to do a whole seminar on that. Where you live in a state with an estate tax and you have a difference between what the estate tax is in your state and this new 15 million. Very important, Alec.
Yeah, I think that's a great idea. So maybe in the next coming months, we'll put out a video strictly on how the estate tax works.
All right.
So moving on to child tax benefits in this new bill, the child tax credit is going to increase $200 and inflation adjustments are going to start in 2026. So it's going to start at $2,200 and then adjust for inflation each year. The child dependent care expense credit, the amount of expenses you're able to include increases from 35% of the qualified expenses to 50% of the qualifying expenses. And then the last one is the dependent care FSA contribution. That limit used to be $5,000. That's going to increase to $7,500.
Yeah, these are pretty straightforward. The child dependent care expense credit is a little more complicated, um, as to how it works. And it's another income level. If you have this income level, you get the 50%. If you have this income level, you're only going to get 20%. And also the amount of expenses that credit is applied to is only $3,000 for one child, $6,000 for two or more children. So the credit is not overwhelmingly beneficial if you have a dependent care FSA. If you have one of them, that's the way to be going. If you don't, then you take the credit. So that's the way to think of that.
Yep. So some couple changes with how charitable contributions are going to be deductible. So starting in 2026, cash gifts up to 1,000 if you're single, 2,000 if you're married, are going to be deductible without having to itemize your deductions. But if you are giving these cash gifts to a donor advised fund or a private foundation, those would not be included with that deduction. As well as if you're thinking about you do itemize, how does that affect your charitable contribution? Starting in 2026, your charitable contributions have to be above 0.5% of your adjusted gross income to be deductible.
Yeah, so let's just talk about what that means. So let's say you make $200,000 of adjusted gross income on your tax return, and you made $10,000 of charitable contributions, then 0.5% of 200,000, $1,000 would be deducted from your $10,000 of charitable contributions. You're only going to get a deduction for 9,000. This is fascinating, Alec, because this is one of the first times that the government has ever limited charitable contributions in any way, shape, or form. The government has always had a policy to encourage charity and to fund charitable organizations. But this 0.5% is sort of an attack almost on that. It's never been done before, as far as I've ever seen, So it's interesting that they were willing to accept this as part of the bill.
Yeah, it's definitely interesting. So another thing that was created with this new bill are the Trump accounts. So these are the accounts that are set up for children. And if you have a child born between 2025 and 2028, that account will be established and receive a $1,000 contribution automatically. Beginning next July, so July of 2026, you can start making contributions up to $5,000 for children under the age of 18. And then once that child turns 18, the account is treated like a non-deductible traditional IRA. So it's important to keep track of the after-tax contributions made to these accounts so you can track that basis in the account to keep carrying forward into the future.
Yeah, this, I have no idea what the purpose of this was, other than maybe Trump to get his name on an account. I can't imagine I would ever recommend to a parent to put money into a Trump account under these terms, non-deductible. So in other words, you put in 5,000, you don't get a tax deduction. The child has to wait until they're 60 to be able to take it out and pay taxes on the growth of the money. But at the same time, they always have to monitor and maintain the non-deductible portion, how much was actually put into the plan. So other than the free $1,000 that the federal government says they're going to give any child born between 25 and 28, I see no benefit to these accounts over and above that. The problem is we have no idea where the $1,000 is going to come from, how to get it into the account, how to set up an account, etc. So, it might be the end of 2026 until a child that I have a great niece that was born in May, I believe, of this year. I think it was May. And she's entitled to this $1,000. But we have no clue whatsoever how to get that $1,000 for her at this point in time.
Yeah, it's a bit of a mystery until we get some more information on these.
Yeah. Anyway,
So another thing that was included in this bill are the extension of opportunity zones. So the current set of opportunity zones are going to sunset at the end of 2026, and now they're going to be a permanent policy starting with new ones in 2027. The eligibility requirements are going to be a little bit stricter, but they are going to emphasize rural investments. They're going to receive a better tax efficiency with a higher step up in basis versus the standard opportunity zone.
now opportunity zones, Alec, are a credible opportunity for certain people who have large capital gains and don't need all the money from the capital gain. So let's say you sell your business and you make $8 million selling your business. You could put $1 million of the gain into an opportunity zone, and you're going to get depending on how you do it and so forth, you're going to get at least an $800,000 tax-free benefit. I'm sorry, $100,000 tax-free benefit out of that $1 million gain going into the opportunity zone. This is a little complicated, but just stick with me now. So I put $1 million of gain in, I immediately get a $100,000 tax-free benefit at least. Okay. I may get up to a 300,000 if I'm using a rural opportunity zone. And then my $1 million grows to $2 million because I picked a good opportunity zone. All the gain that I make comes 100% tax free if the project was in place for at least 10 years. So it's interesting, these opportunity zones. We used them back in 2017 and 18 when they were first introduced for this sunset of 2026. Um, but looking forward to 2027 when we can buy new ones and use them to offset gains of clients. This is a very technical area, but trust me, if you're making big gains, this is something you need to understand and know how to work with.
Yeah, there's a lot of opportunity in opportunity zones with those big gains.
We could do another webinar just on this one, Alec.
Yeah,
So,
you and I could spend 30 minutes just talking about this.
yeah.
So some of the miscellaneous things that were also included in the bill, those are for you that are in that 37% tax bracket are going to have your itemized deductions capped at 35%. So even though you're in the 37% bracket, your deductions are only going to count for 35%. And then deductions for casualty losses in 2026 are the definition is going to expand to include some state declared disasters. And another one about deductions is in 2026, gambling losses are only deductible up to 90%, only if you're itemizing your deductions.
Yeah. And again, this is another one that's interesting. Um, because you don't have a lot of people that, are going to lose their itemized deductions from 37% down to 35. Because in order to be in the 37% income tax bracket, you've got to have taxable income of over like $750,000. Okay. So it's a small universe of people, but still what they normally were getting 37% of all those itemized deductions. Now they're only going to get 35% of all those itemized deductions. If you think about that, if you have $2 million of income and you had $150,000 of itemized deductions, it's going to be about $3,000 or $4,000 of reduced itemized deduction or extra tax that you're going to pay on that money that you would have gotten before under the previous law. So that's an interesting concept for higher income people. Not sure that there's going to be a way to get around that. The deduction for casualty losses, keep in mind that no casualty loss is deductible unless it's due to a federal disaster situation. Now, interestingly, in the past, when a client was scammed, okay, and they lost money due to the scam, that would have been considered a casualty loss, and you could have taken the deduction. Nowadays, that is not a deduction, and or if you have a bad storm that comes through your area, and some reason or another something gets hurt, if it's not considered a federal disaster or a state disaster, it just was unique to your area and your property, you don't get any casualty deduction. It's only if it's a declared. And then there's different types of declared property, Alec. You've got federally declared, and then you have qualified federally declared. And qualified federally declared, you don't have to limit it to 10% of your adjusted gross income. Whereas just a federally declared disaster area is subject to 10% of your adjusted gross income. So this stuff is getting ridiculously complicated. And that last one really irks me, that the government says if you make money gambling, you owe taxes on it. But if you lost money gambling, you can't offset the two at all unless you itemize. And now, if you itemize, you're only going to get 90% of what your winnings are in losses. I mean, really? What do you legalize gambling, but then you start punishing people if they're gambling and winning? I just, Adam Smith said 400 years ago, Alec, that a tax system has to be fair, consistent, simple, and understandable. And if it's not, it's going to fail over time. This stuff is far from simple, Far from fair. And everyone is, some people are favored, some people are not favored, and some people are punished under these laws. Anyway,
Yeah,
that's that.
far from simple is the best explanation for the tax laws.
That is true.
So we didn't include everything today in the new bill, but we wanted to touch on the most important aspects of the bill that most people are going to be affected by. If you have any questions about the bill and you're already a client, you can reach out to either Drew or myself or your primary advisor. And if you're watching this video for the first time and you're interested in becoming a client, you can scan the QR code on your screen or go to our website, and that you can set a introductory meeting with us at no cost to you. I appreciate everyone watching. Thank you, and we'll see you next time.